Hello and welcome aboard to Module 8. In this video, we're going to show how to measure market energy with the Choppiness Index. We're going to show how to set it up on a live TradingView chart and then show the important levels for the Choppiness Index and then translate that to how they relate to market trends. And then we'll compare tops and bottoms in market moves. So again, market energy and trends. So when we talk about market energy and trends, what we're talking about here is a trend is either a straight line trend, right? So this is a trend and it's a very linear move, and this is going to take a lot of market energy out. And then from that trend, we're going to get range contraction. So range expansion moves to range contraction, and we're going to be in a deficit of energy when we start this. And then eventually what we're doing is we're winding up the spring again. I just want to keep repeating the same concept here so that you start looking at markets in new and different ways. In that last module, Module 7, we said that we measure energy expended based on that linearity of the current trend on each time frame. And to measure this on our charts, remember, there's no fuel gauge on our chart, so we have to use the Choppiness Index to do that. So the Choppiness Index measures the linearity of the previous N bars. Typically, we're using a period of 14. And the levels that we're going to look for is a very high level, which is greater than 61.8, means this is a chart at this time frame that is coiled up and ready to trend. If we see it drop below 38.2, that means that a trending market is in danger of losing that trend. So it's trended for quite a while. It's lost a lot of energy. That trend is now in danger of moving into consolidation. And then typically if we see an energy level below 25 for that trend, that means that that trend has been extraordinarily linear and it will fail shortly. Let's go to a live price chart and show how to set up the Choppiness Index and show how these levels come into play on a live chart. Here we have Bitcoin versus the US dollar on a simple price chart. So this is all we have on the chart is currently price. And we can see the swings on here. We can see the swings and the trends. We have higher highs and higher lows, higher highs and higher lows all the way along, right? So this is a current uptrend, but we have no way to measure the energy on this chart and understand when we would likely see a probability of that trend perhaps moving from range expansion to range contraction. Wouldn't that be nice to know? Okay, so we're going to put that Choppiness Index on here. So to find that with TradingView, and I am assuming that most people out there are using TradingView because it does support the Choppiness Index. It does provide this for free, so you can get TradingView for free and decide whether or not you want to add some of the advanced features for a monthly or annual price. That's totally up to you. But the free version of TradingView does come with the Choppiness Index. So no reason not to use it. So here we go. We're going to click on indicators. We're going to look for built-ins. We're going to just scroll down here until we see the Choppiness Index. That's the one that we want. All right, so we're going to get rid of that. Now, with a white background, we're going to see this sort of very quiet little line, and I typically like to make these things pop a little bit. So what I'm going to do is come in here and let's go ahead and hit the settings. So the first one that I want to change here is let's change this to a slightly darker line. Let's make this pop out and let's make it thicker so we can see a very clear indication of where this is showing. Okay, so we have the line here. Now you can also see some dotted lines in the background. And you can see that they're set for 61.8 and 38.2. Okay, so that's good. We can actually increase the width of these lines if we want to. And we can also change the color of them. Let's also change the background here. So we can change the background of this. You can see that if we just change the background transparency a little bit, we can see that this pops out a lot better. And right off the bat, we can see that these levels at 38.2 and 61.8 will pop out very nicely for us. So we can do this for this alone, or we can put that into the background, and then we can we can change the upper and lower bands. We can make those perhaps something like this green here, and we can change this one to red. so that they pop out a little bit better, right? So there's a couple of different ways that we can edit these so that they come out a little bit better. And so let's go ahead and do both of them for right now, just so that we have this thing pop. So we have dashed green lines representing 61.8. We have dashed red lines representing 38.2 or below. Now it looks like we only get 2 lines available for this. Don't know that we can add any more, but we could, if we wanted to, we could change this 38.2 down to something like 25 if we wanted to. But for right now, this is totally fine for us. So now I think you can see, after a little bit of surgery here, the indicator is much more prominent. We can see it much, much better in terms of the highs and the lows. Now let's get into a little bit of analysis. And the first application that I'm going to show you is that range contraction leads to range expansion. Now I want to make sure that you understand that anything that we do along here is not going to be perfect. A lot of people think that, well, wait, if you teach something, then the examples should be absolutely perfect and binary results come out of them. It doesn't work that way. And one of the reasons why it doesn't work that way is because we have multiple time frames. There's other things that are happening in the different fractal time frames that we're not going to account for just by looking at this one time frame. So keep that in mind, and I'll try to explain these as we go on here. So the first one that I want to do again is range contraction leads to range expansion. So when I say range contraction, what we're looking for is generally a value which relates to a high level of energy, or what I would say the full end of the fuel tank. If we assume that the empty end of the fuel tank is down here below 38.2 or lower, then what we're looking for is periods where we have a lot of range contraction or energy winding up into a spring and it's about ready to move. This is very typically what people want to start with, is like, how can I find high probability scenarios where we're going to see the price break out explosively? All right, so this is one of my favorite things to spot, and we'll start by doing it with this chart. So we're going to do this hard right edge. So right now, as the chart winds up here, we have a high level of energy. And the reason why we have a high level of energy at this point is because we basically have no trend whatsoever. There's no trend, but also what we're seeing is what I call rule number 3 of price action, which is that descending patterns break to the upside. And we're seeing a good example of this where we have a lot of energy built up and we're starting to see an upside breakout on Bitcoin. So let's advance this, and we can start to see that that range contraction is leading to range expansion. All right, so we get a nice move from here, and now we're into exhaustion. Now we're into exhaustion. So this might be a place where either you thin out the position, maybe take some profits, or just outright sell out of the position, depending on how your trade strategy is set up, right? There's lots of different ways to do this. Or maybe you raise your stop, which I prefer not to do. Stops are tough to enforce into this market without unnecessarily getting stopped out, but more on that later. Okay, so as we go along here, we would expect to see at some point here this range expansion move to range contraction because we're showing exhaustion. So let's just pull this along and let's see how this market does this. Okay, so we're just sort of moving along here, and then we start to see sideways price action, don't we? So for all these candles, essentially we're getting net nothing as far as the price advance. It's sticking right around the 1200 level as the price goes sideways, even though it doesn't seem like it at the time, but all it takes is one good black candle, in this case a red candle, and this can help charge the chart up. Look how fast it's moving up. And stronger markets will also feature shorter periods of consolidation. When you have a super strong market, they won't want to consolidate. People are buying the dip so quickly, it doesn't get a chance. So along we go here, and we're getting a really good example of range contraction. So this is going to come shooting up here, and it may not even get up to 55 before this starts to trend. There we go. We're up at about 53. We're in a beautiful sideways pattern, beautiful little pennant flag. You can see this a little bit of a, this is what I'd call a pennant, where we have a little bit of a triangle that's just vectoring into the apex here. Okay, and so I would expect to see this break out. Normally, break in the direction from whence it came. So there we go. We see the break. We have a decent amount of energy. It doesn't even get up to 55 before this thing is off and running again. And guess what? We're going to go from this range contraction to range expansion. This is a great example of this. And now we're into exhaustion. Understand that just because the chart indicator down here, the choppiness index, gets into exhaustion doesn't mean that automatically it has to put on the brakes and drop anchor right then and there. This is where we have to watch the price. And this is why it's so important that you start all of your analysis with price, because price never lies. Price never lies. It tells you exactly what's going on with it. It continues to go higher, and we go into more and more exhaustion. So now we're close to 25, aren't we? We're close to 25. This is where I normally would say that I see very, very few trends continue above and beyond this. Okay, so now we're starting to see some black candles in here, and we're starting to see some range contraction, aren't we? Look at this. We're going sideways, 3 bars in a row, sideways. Let's see if we can get a few more. Nope. This is what happens when you have markets like this that are extremely strong. It will continue trending at some point, and then we're probably going to have a weekly exhaustion level here. This is why, again, we're not being able to see the other time frames, and this is why probably a deeper pullback is going to happen at this point, because we're into some super exhaustion on the weekly chart. Okay, so we'll just pull this along. We're seeing, again, range expansion, quick little range contractions. It's just building up enough energy for it to break out. And this is typically what I see on a market where we have fear of missing out. We have people just climbing over each other to get into these coins. Okay, look at this now. We've already reached, through this larger consolidation, we've already reached a level where we're almost at 55 again. But we have to be careful here, because at some point we're going to get, here we go again, it's just taking off, just taking off. We're into exhaustion again. And now I would expect to see a larger pullback. I would expect to see some type of larger corrective action here, because we're getting some very big candles, very big range. We are undoubtedly at exhaustion on a larger time frame. And this is what hurts so many retail traders, because they don't get in here at the bottom when it doesn't feel very good. They didn't get in on this pullback because it was so shallow. They didn't get in here or here. Now we're pulling back a little harder, and now people feel more comfortable about entering the market. And this is normally a big, big mistake, because range expansion leads to range contraction, and that range contraction can be happening at a larger time frame. And there we go. Now all of a sudden, people that bought in at 2,600 are $600 underwater, and we're getting a much deeper pullback this time. And now it continues. It continues. So this is a weekly pullback, certainly a weekly pullback, so we can see how some of these larger time frames do come into play. Now we're going to put all these time frames together in the next module in what we call fractal energy trading. But I think you can see some of these where we have these parabolic moves do produce larger time frame pullbacks here. So the ones that are more complex pullbacks, where we can see lower highs and lower lows along the way, like this one here, this exhaustion level, where we have deeper pullbacks. This is where we get into weekly or maybe even monthly exhaustion. So again, here we go. Market's going completely parabolic. We have a deeper pullback. Again, even more parabolic. We would anticipate a weekly or even a monthly pullback at this level. So let's go through here and watch what happens to this. So we do get a larger reaction from this. So this is almost certainly a larger time frame pullback. Okay, so we get into exhaustion. From range expansion comes range contraction. Okay, so now what we're doing is going through a very, very large time frame consolidation. And this one actually looks like it's setting up as a triangle pattern. like this. You can see how this is starting to vector in on this triangle. Okay, so I have to let these go to push this along. And the implied assumption is at this point, and the probabilities do favor the upside breakout, and we would expect to see the breakout occur when the energy builds up. When the energy builds up. Now, keep in mind that this break can come in either direction, and this is the important thing. The break can come in either direction. And everybody's expecting the break to come to the upside, but what happens many, many times is that the break will actually go in the opposite direction as it creates that larger time frame kind of hook and sets up, and then we get the explosion from there. So this is a nasty little feature of markets that when everybody sees the same thing, it's very apt to go in the opposite direction. But notice how the market waited until it built up a massive amount of energy. So you can see that this triangle, this apex, really broke right around the time that it had the most energy on this study. So guys, what I'd like you to do when you get done with this module is spend some time. First of all, add the choppiness index to one time frame, preferably the daily chart, and go through an example of this. And it's best to have an example of something that's very, very actively traded. Bitcoin is a good example of something that will produce good patterns. Something that is illiquid or very lightly traded will probably not produce the same kind of results. And that applies regardless of what study or what analysis technique that you're using. So apply the CHOP index and start doing some hard right edge analysis on your chart of choice. Understand that range expansion will lead to exhaustion, which will lead to range contraction or some type of corrective price behavior. And then range contraction, building up a lot of energy, will lead to the next trend and next breakout. How do we apply the CHOP index? Keep in mind that this indicator does not signal the direction of the next move. I get a lot of people asking me, hey, if it dips down into oversold, does that mean that we should buy? No, it's not oversold. It means a low level means you're low on energy. It means that you've had a very linear trend. And I would say go back to an earlier module again and understand what the linearity of the trend really means. It's not overbought, oversold. So it only shows us a reading on the relative amount of energy expended on a trend or that's stored up on the chart through consolidation. It shows us when a trend will likely launch or will likely pause. But price ultimately has the final say. I want to add one more thing here, which is something that I typically see in, I would say, more rallies than sell-offs, which is called the S-shaped rally and the parabolic tail. So I see this in every type of market, regardless of what I see. Market rallies tend to come strong off the bottom due to short covering, and then they get very choppy in the middle as the chart sort of finds a balance and the bulls and the bears argue between themselves, and then eventually we finish with a kind of a blow-off top to the upside as everybody chases it. Okay, so how this looks is you get strong off the bottom, right? Strong, a short covering off the bottom, then it gets kind of choppy in the middle, and then you get the parabolic tail up near the top. Okay, S-shaped curve, parabolic tail at the top. Okay, so we're going to see typically exhaustion up at the top. If you see down here on the CHOP index, we have exhaustion as we're getting into that parabolic tail. As we get into the parabolic tail, we have an exhaustion figure. Again, everything in the market can be difficult because it's almost designed to go against your base levels of emotions. When the market's running away and we have exhaustion down here, this is when everybody is saying, hey, market's pretty great, isn't it? And everybody's happy with this. But this is where you're going to say, oh, I would be taking profits into this, or maybe we're going to sell our position into this strength and not adding a position up here. This is the wrong time to add a position at the end of the parabolic tail. Same thing here. We don't want to be adding positions up here. We want to be selling positions into here. Again, this is when everybody's going to say, hey, coast is clear, jump in, the water's fine, and you're sitting there, no, it's at exhaustion. I'm not going to chase this up here. So this is one more example about how the market is really a very contrarian kind of thing, regardless of what market you're trading. Doesn't matter. Another thing I want to bring up here is that tops are a process, bottoms are an event. Market tops are usually drawn out things where they get very noisy and very volatile up at the top, and they go down with a great fight. Now, we are given a warning and usually a lower high, which everybody ignores because everybody's convinced that it's just a pullback and that it will continue going higher. Market bottoms, though, are an event, especially a capitulation, and they can occur very quickly. Little warning, all of a sudden the bottom drops out, and it's a V bottom. It's a one-time event, right? So both of these usually occur at exhaustion levels one more time. So again, we can see that market tops are a very difficult process, very noisy, and they do occur at exhaustion for the most part. And market bottoms can be very rapid and also occur at exhaustion. Market tops are noisy at exhaustion, and market bottoms can be very spiky and also happen at exhaustion. Let's summarize this section here. We can use the CHOP index to understand the linearity of the current trend. Use it as a fuel gauge. We know that 55 and above means that charts have been coiling or are recharged and are ready to move, and that values of 38.2 or below are susceptible to exhaustion and may spell the end of that trend. We also see common patterns to uptrend and downtrend exhaustion. In the next module, we're going to put everything together: price, multiple time frames, market energy, and we're going to call it fractal energy trading. This is where we integrate everything together in Module 9.